In this video, we're going to discuss how an unguaranteed residual value is going to affect the lease accounting for the lessor in a sales type lease. So first of all, just want to make sure you understand what I mean by unguaranteed residual value. So let's say that your company is the lessor and you lease a truck to a lessee, right? So you have to say, okay, well, what do I think is going to be the value, the residual value of this truck at the end of the lease term? And let's say that you think it's going to be $20,000. Now, unguaranteed simply means that the lessee, the group or the person that you're renting this truck to, is not making any guarantee that it will actually be worth $20,000 at the end of the lease. Because of that, there's some uncertainty about whether you've actually sold this kind of unguaranteed portion, this unguaranteed portion of the asset, right? So what we're going to do to account for that, as the lessor, you're going to subtract the present value of the unguaranteed residual value. So in this case, the $20,000, you take the present value of that, and you're going to deduct that from both sales revenue and from cost of goods sold. Right? And so because you're reducing both sales revenue and cost of goods sold by the same amount, your gross profit is actually going to be unchanged. So that's not going to change at all. But your sales are going to go down. Your cost of goods sold are going to be lower when you recognize those things at the outset of the lease. In addition, as the lessor, you may have to recognize a gain or a loss at the end of the lease if there's a difference between that residual value that you had predicted and the actual value of the asset when you get it back. So let me show you how this all kind of comes together with an example. Let's say that your company is the lessor on a 3-year sales type lease. If you don't know what a sales type lease is, I've made another video. I encourage you to go watch that. But I'm going to go through this kind of quickly because we've talked about this before. So we've got a 3-year lease. There's 3 periods, a 6% discount rate. The unguaranteed residual value is $15,000. Okay, so your company thinks that this asset that's leasing out to some lessee is going to be worth $15,000 at the end of the lease term, at the end of the 3 years, but the lessee has not guaranteed that. Okay. Now, the lessee is going to make payments to you, to your company, of $20,000 at the beginning of each year. So this is an annuity due. And the present value of the lease payments is $56,668. And then we got the present value, the unguaranteed residual value of $12,594. If we add those together, that's going to give us the initial lease receivable. And we're going to put that in our effective interest table. Okay, so we've got our $56,668 plus $12,594. That's our initial lease receivable. So the present value of the lease payments, present value of the unguaranteed residual value. Okay. And again, I'm not going to go through everything with the effective interest table. Just suffice to say, we make our first payment of $20,000. That immediately, or when we receive that first payment of $20,000, I should say, immediately reduces our receivable by $20,000. But then the next period, there's interest on that lease receivable, which is 6% times 49,262. That gives you that $2,956, and you net that with the payment to see the actual reduction in the receivable. Okay. I'm going to go through all that. Now, we assume that the final payment to you, so to speak, is $15,000. Whether you actually get an asset back at the end of the lease term is worth $15,000, that's an open question, and that's where we might have a gain or a loss. Okay. So now we're going to have some journal entries, and they're largely, for the most part, they're going to be the same as the regular sales type lease that we talked about before. The big difference that we're going to have is, you see, when we originally have the lease, we recognize the lease receivable and the sales revenue, but we're going to deduct the sales revenue. We're going to say, okay, that's $69,262, which again was the present value of the lease payment you're going to receive plus the present value of the unguaranteed residual value you expect. We're going to deduct from that unguaranteed residual value, the present value of it, I should say. So this is the present value of that $15,000. That's that $12,594. We're going to subtract that from the sale because, again, we're like, hey, this was unguaranteed. We really don't know. So we're not going to include it in our sales revenue. Also, we're going to deduct it from our cost of goods sold. So where did I get this $50,000? Well, I'm just giving it to you in the problem and telling you that this was the cost basis of this inventory. So we're still going to credit the inventory for $50,000, and normally we would debit cost of goods sold for $50,000, but we're going to deduct that present value of the unguaranteed residual value, right? So if you add up the debits and the credits, equal each other here. Then everything is pretty much the same as the regular sales type lease. We receive the cash, we reduce our receivable. When we have that interest that accrues, we increase the lease receivable, and so forth. So I want to skip to the end, and because this is the difference between a regular sales type lease, because it's unguaranteed. Now we had said, okay, unguaranteed residual value, $15,000, right? We talked about that. But let's say the lease is up, right? So like January 1st, 2020, we get the asset back and we find that it's only worth $7,000, right? We don't really have any recourse against the lessee because they didn't promise us. They didn't guarantee that it'd be worth $15,000. So what are we gonna have to do? We're just gonna eat a loss. We're gonna eat a loss, right? So we're gonna credit our lease receivable for $15,000 to bring our lease receivable to zero. And then now we've got this asset worth $7,000 that was just given back to us. So we're going to debit inventory for $7,000. Why are we debiting inventory? Well, remember, when we treated this as a sale or like a sales type lease, right? So we originally debited cost of goods sold, credit inventory, but now we're getting the asset back. But it's not worth $15,000 like we had expected. It's worth $7,000. Okay. So now the difference between this receivable and then the inventory, you see that if we didn't have anything here, our debits wouldn't equal our credits. So we need a plug. So we debit this for $8,000, and we call that loss on the lease. If there was a credit, then it would be a gain on the lease. Now, if you say, well, I don't want to think about this as a plug, how can I think about it? Well, you can think about it like this. You got an asset of $7,000 just given to you at the end of the lease, right? You had taken it off your books, but now it's been given back to you because the lease term is up. So you receive $7,000, right? But you had originally thought you were going to get back $15,000. Okay, so you could subtract that $15,000 from the $7,000 that you actually got, and that will tell you that you have a loss of $8,000, and that's again debited here. And again, if we had actually, let's say that we got the item back and it was worth $21,000. Then we said, well, hey, we had thought it was going to be 15 and now it's 21. You could actually have a situation where you have a gain of $6,000.